Jeremy, thank you so much for joining us today. You were a guest a while ago at our podcast, and I'm so excited to have you here during this period in time. But first, why don't you tell us a little bit about you?
Sure. Yeah. No, thank you for having me, and I hope this is helpful for all of the listeners. So thanks for joining us. My name's Jeremy Roll. I've been a full-time passive cash flow investor since 2007. So I guess that makes it about 17 years. But started in 2002 while I was still in the corporate world. So that was about 22 years ago. And I invest predominantly in stabilized cash flowing, mostly real estate, but also businesses. That's my primary focus. I'm highly diversified across many different asset types. I've been through the last cycle, in the middle of going through this cycle, and very cash flow focused.
Fantastic. And you are a very wise investor, in my opinion. But first, let's jump into what you think the state of the market is. What are you thinking about today? What's in your mind in terms of economy and your investments for the
Yeah.
year?
Sure. So we're recording this in July of 2024, and that's important to note because things are just changing all the time, and especially right now. So, high level, I feel like we on the economy side, I think one of two dominoes has fallen that is really going to impact investors in general. The number one being that the interest rates really spiked up, as everybody knows. That caused a lot of other domino effects and a huge adjustment in prices. It's funny because you don't ever hear anyone using this word, but if there had been a 20 or 30% adjustment in prices in the stock market, everybody would be calling it a crash. I've not heard anybody call it a crash, but that's actually factually what's happened here on the real estate prices, right? And of course, some assets have gone up, down more, and some have gone down a little less, but on average, it's like 15 to 30, say. So there's been a crash, and I think that's domino number one. But domino number two that I'm still waiting for is actually a recession that I think is a very high probability based on all other data, macro data. And then when you get that, you would typically have a stock market crash. And unfortunately, this time around, there is a direct correlation between the length and an inversion of a yield curve, how long that goes for, which is at a record right now, and the amount that the stock market goes down during a recession. So if you were to chart it out, which I've seen and I've done, you basically right now, it implies like a 45 to 50% stock market crash, which honestly, even when I say that, I can't picture it, but that's actually what should theoretically be due, taking history and applying it to today in terms of the length of the inversion. And by the way, the real simple reason for that is because the longer a yield curve is inverted, theoretically, the higher the stock market has gone before it corrects, right? Because it's just a longer and longer out. So it actually makes sense. So I'm bracing for a very major second domino to fall that not a lot of people I think are talking about. And a lot of people are talking about interest rate cuts. I'm expecting that at least one and possibly two before the end of the year. But I think what a lot of people tend to forget is that the reason why they cut rates is because there is a recession or about to be a recession and the economy is doing bad. It's not just randomly happening. And so, we had some actually interesting data today. Today, they released the CPI data. And actually, the CPI was negative 0.1 month over month. And it was at I think it was at 3.0% for year over year. That's the regular CPI. The core CPI was up about 0.1%, I think 3.4 or something like that. But it's definitely trending down. And actually, I think there's a very high probability that CPI is going to continue to trend down because 43% of the CPI is comprised of what they call owner's equivalent rent, which is a highly, highly like 18 to 24 month lagged indicator of rents. And so basically, the CPI number has been overinflated for a long time by measuring rent in a different way than the actual real-time data we have. And now it's catching up to the rents that have been declining, or at least the pace that's been coming down in a lot of markets for the past 12 to 18 months. And because of that, we have a lot of months left where it's going to impact the CPI data in a negative way, meaning it's going to continue to go down. So I think that because of that, the Fed is almost certainly going to end up reducing rates towards the end of the year. But while that sounds great, again, that's usually in response to bad economic situations. So I'm still waiting and bracing for a very bad economic, 6 to 18 months ahead, possibly after the elections, we'll have to see. And then I think we'll have probably the best time to buy since 2009, basically.
Wow. So you said you think we're heading to a major recession because of multiple macro variables besides the yield curve. What else
Yeah.
that you may not have mentioned? right
Sure,
now?
yeah. And I would just want to preface it by saying I'm not sure we're going to have a major recession necessarily. I think we're going to have a significant stock market correction because that's been running for so long because of the length of the inverted yield curve. The actual severity of the recession is much more complicated to kind of determine. I don't have one opinion or another about that. It's funny because everyone looks at the unemployment rate. It's currently 4.1%, and that seems very low, and it is historically low. But the trough of that was actually 3.4, the bottom. And typically, once you have over a 50 basis point increase in the unemployment rate, as an example, you're basically due for a recession very shortly thereafter. Yeah, and that we've already hit the 4 and a 4.1, months ago. And so there's literally like countless like indicators of just, and I also want to warn everybody that if everyone thinks, oh, the stock market's doing great, nothing's ever going to happen. The funny thing is that the stock market usually starts to go down 1 to 3 months after the first rate cut. So not until
Hmm.
after the first rate cut, right? Some people think, oh, there should have been a crash if the economy is not doing well. That's not the way that it works. There's like a whole process to it. And if you're not familiar with it, I definitely recommend you research it because the more you know, the better informed you are, and the more you can actually be prepared to go in at, what you think might be the right timing. And so, I was looking the other day, I think the projected GDP from GDP Now for Q2 was 1.5%. We'll have to see what it comes out at. It's a very well-known fact that unfortunately the jobs numbers, I think 70% of that number is literally estimated fabricated. And if you take a look at what's happened,
Yeah.
unfortunately, in the last 1 to 2 years, it's all been revised significantly lower to the point where some people think that a recession started about October of last year because of that. And so we'll know that in
Right.
hindsight. So there's a lot of very specific, because I just read so much stuff. There is a lot of and they're all lining up and it all makes sense. And, watch for the yield curve to start to flatten and then steepen again to back to normal. That happens typically before everything just hits the fan. And then you watch the rate cut. And then I would expect to see the stock market go down within a few months after that.
Okay, so it's fair to say you all have been warned.
We'll see. I mean, you never know, but
Yeah.
that's what you would expect given the past history.
So are you selling your stocks? What are you doing right now?
I own no stocks. I haven't owned any real stocks since 2007. So yeah, I'm all in on the alternative investing for cash flow. What I'm doing with that space is I am very much on the sidelines with very few exceptions right now. The best way I can describe my thought process is, if somebody says to me today, it's July of 2024, what should I invest in? What are you doing? My answer is, well, if you asked me that question in July of 2008, what would be a good answer? Like, oh, just wait, And I feel like, even though I'm not saying it's going to be the exact same type of, I feel like the timing is very similar. And so that's really where my mentality is in terms of waiting. And just keep in mind as well that real estate tends to move very slowly. So personally, it's very different. It's the opposite in the stock market, which moves very quickly. So with real estate, you're better off being a little late than a little early. All right. Because if you're a little late, you have plenty of time because it's not going to just shoot back up in a year. It doesn't work like that typically.
Yeah.
And it's also going to be very interesting to see the banks. The banks have very few failures so far, but with the degree of interest rate increases we've had, I mean, there's been some very high profile, very smart billionaires all saying that they're expecting hundreds of banks to eventually fail. And I agree because historically that's what would happen in this type of environment.
Okay. Well, thank you, Jeremy. You are always a wealth of information. How many deals do you have right now under your belt, and how are they doing?
Yeah, so I'm like highly diversified because I'm just full-time and doing it for so many years. So I'm currently in over 60 active LLCs. I've been in over 150 to 200 plus over the past 22 years. They're all different because some of them are like from the 2000 era and some of them are from last year or even this year. And so one thing that I think was very important is I didn't invest in any floating rate bridge loan apartment deals, which was very difficult to not do because in 2020 to 2023, let's say, literally 90% plus of anything I got was that. If you want to invest in anything, it almost had to be that. But it didn't match with my bucket, which I typically look for a 10-year fixed rate loan long-term because I'm looking for predictable cash flow. So I sidestepped that, so I'm not dealing with any of that, thankfully. Although I know a lot of people are, and I feel horrible about what's going on right now. Right now I'm in one, on the real estate side, I'm in one deal that is kind of borderline-ish, I'll call it, which is a retail strip center that I invested in back in 2014 with a 10-year loan. And the only issue with it is that literally we had a buyer because the loan was coming due this summer. And literally, as they were under contract to buy it, with I think 2 or 3 months left, one of the major anchor tenants, 99-cent stores, announced that they were closing all the locations in California, I believe. And it was literally while it was under contract to sell, right in the 11th and a half hour. So right now, the sponsor is trying to find the tenant to replace that anchor and is basically been continuing the loan payments, even though the loan is due, and talking to the lender to sort out what to do about it. So that's the one piece of like a real estate distress. I'm trying to think like that's the one true, I don't know if it's a stress because it's current on the loan payment, but trying to think if there's anything else I can pass along on the real estate side.
Anything with insurance problems?
When you say insurance problems, what do you mean?
Like double, triple, quadruple.
Oh, yeah.
Insurance.
Look, a lot of things have been hit, especially multifamily, by insurance increases. That has reduced cash flow in some of the things I'm in. It's probably hit it by a couple of points, per year. It's interesting though. I'm in one sponsor who has multiple billions of dollars of multifamily, and I spoke to them this week, and they told me that they actually went overseas to negotiate with a lender, an insurance company in the UK. And somehow, because they said the insurance companies are cheaper over there, they're literally going to reduce the bill for insurance across their properties by 30 to 40%, which is ludicrous when you think about what's going on in the US right now. I don't know how they're pulling it off. It might be their scale. So there are some solutions, but I know a lot of people have been struggling with that. Now, the thing is, so if I give something that's stabilized, and I don't go into anything that's negative leverage or anything like that. And so when you get an insurance hit, it reduces cash flow. I'm all like, 85 to 100% occupied, stabilized. You're not going to go negative. You're not going to have a problem covering debt. None of that. You're just dealing with less cash flow, essentially.
Oh, thank you. So what were some other things that you think you did right so that you only have one property that is a little bit hurting right now?
Yeah, and that one that's hurting is, who can predict that chain is going to close while we're in a contract to sell it in a 99th hour before the loan is due that month, right? That's actually what I call a 1% risk. And it's really important to understand, to learn from that, because you have like 20 different 1% risks all the time in any deal that seems perfect. And that's why it's important to be diversified. What I would say for this particular cycle, so back in 2005 to 2008, I did not, at that point, I was on hold because of real estate valuations. And I was only in one foreclosure, and that was similar situation to this in 2012 or 13, unrelated to the downturn. It was one of those 1% situations. That's the only foreclosure I've ever been in, I think. Now, they may or may not have this one foreclosure, we'll see. But besides that, I think that I'm in relatively good shape because, when I was looking at these bridge loan deals, I wasn't saying to myself, I shouldn't do those, interest rates are going to skyrocket. I didn't know what was going to happen with interest rates. What I was saying to myself is, it doesn't fit my box, and I'm not going to conform to a different box just to deploy cash, which is very difficult to do. You have to be very disciplined. So that's number one. But more importantly, because I follow the macro data, in 2020 and 21, we were at a record long economic cycle. And when someone is presenting a deal to me that, let's say, is 3-year bridge loan, which I don't do anyway, but let's say I was considering doing, I would have to take a hard look at that and say to myself, we're at a record long economic cycle. We will eventually have a recession. Is this the right time to do a short-term loan type of structure?
Right.
And it's higher risk at the end of a cycle and lower risk at the beginning of a cycle. So I'll entertain a shorter term, when I say short term, 5 to 7 year deal, shorter term for me at the beginning of a cycle, but not at the end of a cycle. So that was one of the key things that I did as well. As I said, this is the wrong time to entertain anything that is medium or high risk because we're at the end of a cycle. I don't know when it's going to end, but we're close to or at the end of the cycle. So,
and when did you start thinking that? Which year?
So here's the interesting thing. At the beginning of 2017, we were heading towards a recession, and we would have had a recession in the spring of 2020 had there not been a pandemic. There was an inverted yield curve for a long time already. So I was pushing sponsors to sell stuff in 2017 to 2020. I was in over 30 exits, and that to me was really when I was like, I'm doing nothing except for it's really unique, those 3 years. And it was exactly the right timing had there not been a pandemic that then caused the money printing, and money printing just extended the cycle basically, right? Yeah. So I was all the way back then. So if you think about it, I have been sitting around for 7 years trying to be disciplined. And that's why I'm in this position right now. And by the way, I've given up a lot of returns. Some people have done much better than me during that time, to be fair, who have taken more risk. But now I'm in a good position maybe I had lower return, lower risk at this point. I didn't do any of the shorter term deals, but I'm also not in a lot of distress at the same time. Because that's also doesn't match my personality anyway. So, but I'll tell you, I still think we need to wait. It's very difficult, but I think until you really see the full adjustment and carnage, which I don't think we've seen yet, unfortunately, that's when you're going to have the proper opportunities. You've got to look for positive leverage in real estate, and we're almost not seeing it still.
So when you see the carnage, would you buy office in San Francisco?
That is not my personality because I look for stabilized properties. So, but my answer is yes. If you have the personality for that, that is the time to do it. And by the way, when you see an 80% reduction in pricing, which we've seen, you can argue that is the time to do it. And it does, I think it does make sense for people to have done that already. Just doesn't fit my personality. What I'm looking for is positive leverage by, let's say, 150 plus basis points, because honestly, historically, that's what we would get as a risk premium. It went completely away. It was all negative leverage. And we're barely there even on C class right now. And on B and A class for multifamily, for example, we're still not there. And in some cases, we're still negative leverage, which is crazy to me. And that tells me that we haven't had the full reset yet.
I feel like we should have a quarterly update with you, Jeremy, if you'd like to come on the podcast, because you're such a wealth of information.
Yeah, no, I'd be happy to do that. Yeah.
Yeah. Is there anything else that you think is important for our audience to know that we haven't covered yet?
No, just be very careful right now. I am basically feel like I'm sitting on a beach. I see the storm coming. I'm just waiting for the calm before the storm. But once the storm passes, times will be better. And that's exactly where I think we are right now. So just be very careful.
Jeremy, thank you so much for making the time. I really appreciate it. How can our listeners get in touch with you?
Yeah, absolutely. No, thank you for joining us again. Hopefully this was helpful. Anyone's welcome to reach out to me for any reason. My email is jroll, JROLL, at Roll Investments, ROLL, investments with an S.com. So jroll at rollinvestments.com. If there's any way I can help, feel free to reach out. And as always, all of this information will be under show notes. Jeremy, thank you so much.